So, are you a bull or are you a bear with respect to the current housing correction and potential housing crash? I'm sure inquiring minds want to know. And guess what? Today is the last Tuesday of the month, and you know what that means? Case Schiller data is released today. So, welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is November the 29th. The month is almost over. Hope everyone had a great Thanksgiving holiday. And guess what? Randy Patrick here, putting the realism back in real estate. Let's get at her right away here. So, of course, Case Schiller's data is out, and this will be important for what we're going to talk about in a second here. So, of course, Case Schiller releases her information on the last Tuesday of the month, so it's out today. Basically, the S&P CoreLogic Case Schiller Home Price Index basically continued to decline in September. Now, realize that this calculation, this index, is a 2-month lag. So obviously we're in the month of November, end of November, and we're talking about September, I guess you could say, results or value. So Case Schiller's calculation works on sales pairs and does a little more history, a little more calculations, more intense. That's why we don't get it the very next month like we do something from National Association of Realtors. A little different here. Okay. Ultimately, in the end, all indices came down in value, and it's slowing down. Miami, Tampa, and Charlotte were the locations that led the way with respect to home price appreciation. As has been the case for the past several months, our September 2022 report reflects short-term declines and medium-term deceleration in housing prices across the U.S. So it's actually happening. It's now reflected in Case Schiller. As I mentioned before in videos months back, that it was going to take a couple of months to start seeing this within Case Schiller based on how the information is calculated and how their index works. So despite considerable regional differences, all 20 cities in our September report reflect these trends of short-term decline and medium-term deceleration. Basically, we actually had the best performing cities were Miami, Tampa, and Charlotte, and Atlanta. Southeast and the South, the strongest regions by far. Worst performing cities, San Francisco and Seattle. As far as the Federal Reserve continues to move interest rates higher, mortgage financing continues to be the more expensive, and housing becomes less affordable, clearly. Given the continuing prospects for a challenging macroeconomic environment, home prices may very well continue to weaken. So, of course, they're saying, yeah, we'll start seeing continue to see weakening home prices as time goes on based on the current economic environment. It's nothing that we don't already know, and that every other financial or analyst or economist has actually spoken about in the past 1 or 2 months here. So no surprises. I guess you could just say Case Schiller just verifies what we're talking about here. So this is the sort of, year over year graph of home price appreciation based on the 3 indices, the national, the 20 city, and the 10 city index. All right. So you can see there's 3 different lines. If you go to the right-hand side of the graph, you can see that there's exponential raise, a little dip, and then there's sort of an exponential drop. So there still is year-over-year appreciation, but we're seeing the pace of that appreciation slowing down dramatically. So that's what we have going on. With respect to the I guess you could say the history of this, going back to 1987, we can see that the 2006 was the peak. We can see that where we were in the peak in 2022. And if you take a look at the top right, the peak is there for all 3 indices, and it's actually over the top, and it's on its way down now. For a closer look, this is actually what it looks like if you blow it up. It's not that exciting, folks, but again, I just want to show you. It's obviously blurry because it'll blow it up, but you can see that there is a definite peak, and now we're past the peak. We're kind of going down now. Clearly, and people will argue, saying, "Well, listen, having a 1 or 2% decrease in home values or the index is not necessarily material," and you're right. I agree with that, but it's a start. So obviously, we have a little more fresher and real-time data with respect to what National Association of Realtor produces, other data, etc. So we can see the trends already happening, and this is really the follow-up saying, hey, what's happening is indeed real, and it's going to reflect in the Case Schiller information. So ultimately, where we're at is the former peak was July 2006. The trough was February 2012. The former peak to trough was negative 27.4%. So nationally across the board, home price appreciation or housing values lost 27.4%. Now, from the trough to today's value, we're up 62.7%. It was almost 68% a couple months ago, so we can see that it's slowly starting to erode now. Still, 60, almost 63% from the trough is pretty good for most people. Essentially, the percentage points over 100,000. So if you bought a property during that time frame, you've basically doubled your money and you're doing quite well. If we go and take a look at the individual cities, it's actually kind of interesting because no longer are we seeing the 30 plus year over year. It's kind of dropped down. So Atlanta, 17.1%. Boston, 8.8%. Charlotte, 17.8%. Chicago, 10%. Cleveland, 10.6%. Dallas, 16.3%. Denver, 9.3%. Detroit, 8.0%. Las Vegas, 12.9%. Los Angeles is 8.8%. Miami, 24.6%. Minneapolis, 6.5%. New York, 10.6%. Phoenix, which was the darling of the Schiller reports. It led the nation in year-over-year home price appreciation every month for 30 some odd months, and it was peaking at over 30%, is only at 12.6%. So again, the bigger the markets, the faster, the harder the appreciation. It's going to slide just as hard on the way down. Portland, 6.7%. San Diego, 9.5%. San Francisco, 2.3%. Seattle, 6.2%. Tampa, 23.8%. Washington, 6.5%. So again, we take a look at a San Francisco, 2.3%. That's the lowest, and I believe Seattle is close there at 6.2%. So it was the West Coast darlings that now are showing the most erosion in price point. That's the year-over-year change on home price appreciation. So from today, from this time last year to today, that's the percent change. So yeah, home price is still appreciating. The pace has slowed down dramatically. When you actually take a look at the August-July change and September-August change, which are columns 2 and column 3, you can see that everything is negative there. So the subtle changes on a monthly basis are negative. So it's definitely losing, and that will eventually catch up to what's going to happen on the next little bit in the future. So again, as we see no more 30% plus year over year, again, the highest, which was what? It was Miami at 24.6. Now we're seeing a lot of these cities drop below 20%. A lot of them are dropping below 10% year over year. And again, we look at a San Francisco 2.3% year over year appreciation. Well, guess what? That's getting kind of low, and that's eventually going to start to go down the other way, and they're going to start to lose. So we're getting close in some locations. So, by the way, guys, if you appreciate the information I provide, if you could subscribe and please help my channel grow, I appreciate it. Thank you very much. All right, so let's move on here. Investor home purchases dropped 30% as price increases slow down. So obviously the case Schiller is kind of like the data that we know that's coming. It just reaffirms and revalidates what's going in the housing industry. So we get that. I personally like to hear, my intel, feet in the street information of what's going on in the real world, which is people moving and shaking and doing deals. So obviously when you have markets like this, what happens? Investors pull back first. Investors pull back their purchasing. They try to liquidate, and they take a look at what's going to happen in the marketplace, and they adjust accordingly. So investor home purchases dropped just over 30% in the third quarter of this year compared with the same period last year, according to Redfin. The drop in investor sales outpaced the drop in overall home purchases, which were down roughly 27% in the third quarter, which still shows you that a lot of investors, a lot of probably REITs, hedge funds, institutional investors, larger investor groups were still buying property. They're still buying property, but they're remarkably pulling back. Home prices are still higher compared with a year ago, but the annual gains are shrinking at an unprecedented pace. Exactly. So we're decelerating. This is the funny word, how you could put this, or word play here. We're decelerating at an accelerating pace. That's what's happening right now. So the annual year over years are going to get eventually zero, and then are going to work in the negatives pretty soon. All right. So yet another thing I want to speak about here, Morgan Stanley slashes its U.S. market outlook. Here's where it sees the home price correction going in 2023. We'll talk about the bear and the bull in a second here as part of this article. But yet one other group, everyone chimes in now because, again, if you're a financial analyst, company, economist, whatever it is, financial advice, I guess you have to participate in this discussion or else you probably look silly, and you got to give your 2 cents worth here. So, of course, Morgan Stanley basically says, hey, we think we expect U.S. home prices to fall around 5%, including the 1.3 dip between June and August in the second half of 2022. So, I don't like the word, in this case, the word, I'm sure it's a flagged word. It's got to be an AI type flag word here. It's conservative, and it's not a political thing. It's like they're being conservative in their analysis or their predictions of what's going on in the housing market. If we go to the next page, it says, well, home price correction won't stop there. They expect home prices as measured by Schiller to fall another 4% in 2023. In total, the Wall Street Bank expects home prices to fall around 10% between June 2022 and the bottom of in 2024. So here's the thing. Previously, they had predicted a 7% peak to trough decline. So they're actually revising from 7% to 10%. And I got to say that this actually is not a very strong estimate, because you've already got Fitch Ratings, you've got Goldman Sachs, you've got Moody's Analytics, who are predicting 15 to 20 across the board, with many locations actually going 25, 30 and greater, again, depending on the location and how fast they rose in the past. So again, this is a very tempered sort of, I guess you could say, prediction on their part. The last housing correction, which saw home prices fall 27%, which I mentioned, was anchored by high unemployment, pressurized affordability, shady mortgage products, and a supply gut. This time around, we have what Fortune calls a pressurized affordability, frothy home prices, coupled with spike mortgage rates. So some different sort of financial issues that are sort of pushing the home prices down here. Median price for existing homes sales is up 38% since March 2020. Mortgage rates are up over 300 basis points. It's the first time we've seen anything like that since 1980-81, because they went up 300 basis points in about 8 months, right? So a combination of these two has caused affordability to deteriorate faster at any point in our time series. So yeah, and again, I will be clear here and sort of say, well, what we don't include, or what nobody ever talks about or includes with respect to where the housing market's headed, if we have correction numbers and all this devaluation going on to the tune of 20+%, nobody talks about that. You know what I'm going to say. It's the pre-foreclosure, delinquencies, forbearance, all that other distressed stuff that has yet to make an impact or be available in the marketplace. So, as I said, I call this a true correction. When the other stuff, when all the foreclosures and everything starts to become a problem, that's when we'll have, I think, an official crash. All right. So again, we look at the affordability shock here, what's going on. But again, the people who are saying we're not going to have issues, they're going back to the inventory. So tight inventory won't stop home prices from falling, but it could create a floor. Well, the issue is that on a year-over-year basis, mortgage purchase applications are down 40.7%. However, it hasn't translated into surging supply levels. Inventory levels in October were 37.6% below October 2009 levels. So again, we are seeing an increase in inventory. So inventory has gone up. It hasn't gone up dramatically from the existing home sales. There's a significant amount of inventory on new home construction, though. That's above 6 months. That was like 10 or 11 months a couple months ago. So that's up there. There's volume and inventory there. But we haven't seen a huge increase, even though it has increased every month. For the past 8 or 9 months, we're not at a 6 or 7 month worth of inventory. We're at about 3.3 according to the last NAR information. So that's where we're at right now. But either way, the argument can be made that tight inventory is still going to possibly what the bull case here is. What, and again, this is where I say, are you bull or are you bearish on what's happening in the housing market? Well, the bull case is that home prices stopped falling in 2023, and the reason being, tighter expected inventory levels and lower than expected mortgage rates. So in other words, if people aren't putting their homes out on the market for sale, that's still going to create tight inventory, which should still keep home prices up. And if the Fed decides that their monetary policies are changing and whatever their interest rates are having an effect on inflation, they could reduce interest rates, which would then put us sort of back where we started, and make homes more affordable, and that'll cause yet another flurry of run up on prices. So in a bull case, the lock-in effect keeps inventories at the lows where we've experienced the past year. At the same time, lower mortgage rates incentivize more purchase demand than we are currently expecting, as households view any rally as a potentially temporary reprieve and move to take advantage before the next move higher. So what's called the reason why we have an inventory issue is that we have what's called this so-called lock-in rate effect. So in other words, if I have a house that I want to sell and my mortgage rate was taken back in the day when I had a 2 and change or low threes, that's a really good mortgage rate. Now, if I sell my house, my loan gets paid off, and I don't get to port that loan or that mortgage rate to my new purchase. I have to purchase today and then jump into whatever 6.5% or 7% type rates. So people are afraid. There's a group of people who are not going to sell because they know if they sell, they're going to not be able to sort of get the lower interest rates which they want. Therefore, it's kind of a wash to them. So that's what we call the rate lock effect, which is happening right now. So from the bull case, their perspective is, hey, it's not going to fall as much, and we will see some rate decreases, and the market will pick back up as well. And again, nobody mentioned the foreclosure stuff. And going to the bull case here, people who speak about foreclosures, I was talking about that today with somebody. The fact of the matter is that the pundits always say you have all this equity, okay? And if you have all this equity, you can sell your home and pay off your debts and walk away with money in your jeans. That may be true, but equity does not equal cash flow. So if people aren't paying their mortgage and they're behind, they're having financial difficulties for whatever reason, they don't have the liquid cash to put on new roofs, improve the property, add the, remodel the bathrooms and the kitchens or whatever. So things that buyers look for to pay market value or a premium to get access to all that equity isn't necessarily available for people who are facing foreclosure because they don't have the cash for doing so. Thus, if I'm a buyer and I'm looking at that property, I'm going to adjust my purchase price accordingly, saying, listen, you want X for the property, which is great, but I know that I'm going to have to do the roof and do this and do that. It's going to cost me 50 grand, 75 grand, 100 grand, which means my offer price will reflect the money I'm going to have to put in the property. So that sort of, so-called, I just call virtual equity, isn't going to really be available when people really need to sell. Okay, when they're at their last sort of bit of situation before they get foreclosed on, they're going to get caught, and that's what's going to actually happen. So please keep that in mind. That's not always the easiest way to go here. The bear price, or the bear case here, is that home prices crashed 20%. Well, and again, they're just going based on what all the other consultants are saying. So as I said, Fitch, Moody's Analytics, Goldman Sachs, you've got John Burns Consulting, you've got CoreLogic, so you've got all these financial people who are chiming in that are basically saying 20% is going to be, bank on a 20% correction. If a deep recession manifests, Morgan Stanley predicts U.S. home prices could crash 20% from peak to trough, including up to an 8% home price decline in 2003 alone. Even if this bear scenario were to manifest, Morgan Stanley doesn't believe there'd be a full-blown repeat of the 2008 crash. Again, going back to the sort of conservative estimate here. So yeah, bear case is crashing 20%. I personally believe it's going to crash more than 20%. I think that's pretty obvious. But they're going back to, we have, higher lending standards, so people aren't going to be in as much difficulty. And by the way, our lenders have more foreclosure prevention programs right now, et cetera, et cetera. Well, that's all good and fine and dandy, but in the end, if you take a look what's happening in the industry right now, what's going on, those aren't working, okay? So as I said, if people who have equity should sell, they're not selling. Why? Because they can't sell and make as much money as they thought they would, and when they sell, they've got to start paying and going someplace else. Whether they're buying or whether they're actually renting, right now they're paying zero. Their housing cost is zero, and suddenly they're going to have a housing cost. If you're renting, rent is going to be expensive. Okay, so it's going to be sticker shock for these people. The argument obviously here is that we've had higher credit standards, so the people who are getting mortgages today are stronger candidates. Well, you know what? That doesn't, the economy doesn't look at that. Inflation, the economy, price wars, whatever we have going on here, that that doesn't look and say, well, you were a better borrower. If you can't pay, you can't pay. So it's not a fact that you're a less than worthy borrower. It's the economic and personal and financial issues you find yourself in that causes you not to pay your mortgage, whether you have either good credit or not. To me, that's immaterial. And again, the foreclosure alternatives, which are things like forbearance, which is only a short period of time, or a certain lifeline you have, then eventually loan modifications. We know that lots of loan modifications do not work out of the gate. We know lots of loan modifications that do get implemented end up redefaulting at a very, very high amount within a couple of months. And people are just going to go, I've had enough, I'm going to give up. So that's the way this kind of works. So again, are you a bull or are you a bear? I'm basically, I guess it depends on how you want to say it. I'm a bear in the fact that, yeah, the housing market is doing poor. It's going to continue to do poor. It's going to get worse than we imagined, and we'll have to pick up the pieces when the time comes. But that in turn will create opportunity at various levels for different people, whether you want to purchase, invest, or do whatever. So again, you got to keep your options open here. So by the way, if you haven't had a chance to get access to my report, which says bubble to correction, then crash to crisis, how the housing market imploded in 6 months, send me an email at that email right there. I'll fire you off the report. Also, I've got some discount specials going on with some of my education products right now. Everything I do or talk about or teach or get involved with has to do with the housing market and where we're headed. I can tell you that that part of the business has picked up dramatically, and suddenly people now are very interested in what's going to happen in the end in the housing market. And there's a big, again, as I said, you may not have thought about this last year or the year before, thinking, whatever, the guy's just talking out of the side of his mouth or whatever. But guess what? It's actually happening. So that's the fun thing. It's actually going on. It's happening. Now we actually have the financial people who are actually supporting and saying, yeah, we're going to correct 20%. They may call it a crash. I don't think it's a true crash. I think we'll be to 30 to 35% on a global basis when the foreclosures hit. So keep that, smoke that in your pipe, I guess you could say. If you want information as to what I talk about, you want to check out what's going on in your backyard, your neighborhood, go to gethousingdata.com. That's gethousingdata.com. You can check out the distressed properties in your neighborhood. That's my affiliate link with foreclosure.com. So go to gethousingdata.com. That's gethousingdata.com. If you want to reach out to me, obviously I got lots on the go here. I'm looking for all sorts of opportunities to work with people, investments, lending partners, syndications, the whole bit. So, and again, new programs going on here. Got some good discounts going on. So, it's the Thanksgiving week, I guess you could say. So hook me up, or give me a shout, and I'll hook you up, and we'll get going. All right. So once again, guys, appreciate the views, likes, comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. I look forward to speaking with you in a couple of days. Thanks.